For decades, aviation operated under a simple assumption: when safety and profit conflicted, engineering always won. Boeing was considered the institutional proof of that belief. The company that defined modern aerospace reliability appeared structurally incapable of compromising safety for financial gain. Yet the collapse that followed did not begin with mechanical failure. It began when leadership quietly redefined what success meant inside the organization. The decision under trial is not the design of a single aircraft. It is the moment Boeing chose financial efficiency as its governing logic while still operating inside an industry where failure carries irreversible consequences. Executives believed they were modernizing performance. Markets rewarded discipline. Shareholders celebrated efficiency. But aviation does not tolerate optimization errors. When incentive systems shift inside safety-critical institutions, consequences accumulate invisibly long before disaster becomes visible. What followed was not an accident sequence. It was a predictable exposure created years earlier, when financial engineering began overruling engineering authority itself. At the peak of its dominance, Boeing faced no technological crisis. Airlines trusted its aircraft. Regulators respected its processes. Engineers held institutional authority unmatched across the aerospace industry. The company's competitive advantage was cultural, an engineering doctrine built over generations where caution was treated as strength, not inefficiency. The contradiction emerged when external pressure changed the battlefield. Wall Street no longer evaluated aerospace firms by engineering excellence alone. Predictable quarterly performance became the new command metric. Investors compared Boeing not to aerospace peers, but to highly optimized industrial corporations delivering consistent shareholder returns. Leadership interpreted this shift as evolution rather than risk. Efficiency programs expanded. Cost discipline intensified. Financial targets migrated from accounting departments into operational decision-making. Slowly, success stopped being defined by aircraft longevity and began being measured by capital performance. Nothing appeared broken. Profits improved. Market confidence rose. Yet internally, authority was migrating away from those trained to prevent failure toward those trained to maximize return, the first signal of incentive distortion taking hold. To understand why this shift mattered, the institutional terrain must be reconstructed. Aerospace manufacturing operates under asymmetric risk. A minor financial inefficiency produces temporary losses. A minor safety miscalculation produces irreversible catastrophe. Historically, Boeing's command structure reflected this reality. Engineers possessed veto power because technical uncertainty outweighed financial pressure. But leadership restructuring altered this balance. Corporate headquarters moved farther from engineering centers. Executive leadership increasingly emerged from financial and managerial backgrounds rather than technical ones. Decision authority centralized around performance metrics understandable to investors but distant from design risk. Inside the organization, incentives adapted accordingly. Managers learned advancement depended less on technical caution and more on schedule adherence and cost containment. Engineering resistance began appearing not as protection, but as delay. The institutional immune system that once prevented escalation started weakening. This transformation did not require malicious intent. It required only alignment with new incentives, a command environment where efficiency gradually appeared indistinguishable from competence. The decisive pressure arrived through competition. Airbus introduced aircraft designs that threatened Boeing's dominance in the single-aisle market, the most commercially valuable segment of global aviation. Airlines demanded fuel efficiency improvements without retraining pilots or disrupting fleet economics. Speed became strategically critical. Boeing leadership now faced a defining trade-off. Designing an entirely new aircraft required years, massive investment, and uncertain shareholder reaction. Modifying an existing platform promised faster delivery and preserved financial stability. On spreadsheets, modernization through adaptation appeared rational. Warnings existed. Engineers understood that incremental redesign on legacy architecture introduced complexity. Integration risks multiplied. But within the evolving incentive system, delay carried visible financial punishment while technical risk remained probabilistic and distant. The organization selected the option that satisfied immediate market expectations. At that moment, the outcome was not yet failure. But the escalation pathway had been chosen, a decision shaped less by engineering certainty than by financial survivability within modern capital markets. Inside Boeing, the decision to modify an existing aircraft platform instead of designing a new one did not pass without resistance. Engineering teams recognized the technical compromise immediately. Larger engines required aerodynamic adjustments that altered flight behavior in subtle but consequential ways. Managing those changes demanded careful system redesign and extensive pilot retraining considerations. But organizational debates no longer occurred on purely technical grounds. Time to market had become a strategic weapon. Executives feared losing airline orders to Airbus if development slowed. Financial exposure from delay was measurable and immediate. Engineering risk, by contrast, appeared theoretical and manageable through software correction. This asymmetry reshaped discussion outcomes. Meetings increasingly framed caution as obstruction rather than expertise. Engineers argued from uncertainty. Leadership argued from competitive survival. Under modern corporate incentives, certainty tends to defeat probability, even when probability governs physical reality. The debate ended not because risk disappeared, but because organizational power had already migrated toward those responsible for financial continuity rather than technical preservation. Once the strategic direction was chosen, institutional behavior adapted rapidly. Program success metrics emphasized delivery schedules, certification speed, and cost containment. Advancement increasingly depended on meeting timelines rather than expanding safety margins. Managers learned an implicit lesson. Problems delaying production created organizational friction, while solutions maintaining schedule preserved career momentum. Risk reporting began transforming psychologically. Concerns were reframed, minimized, or deferred into later stages where resolution appeared easier. No executive ordered safety to be ignored. The system no longer required explicit instruction. Incentives performed the work automatically. Engineers faced subtle pressure to solve problems within existing constraints rather than question foundational assumptions. This marks the operational phase of incentive distortion. Institutions rarely abandon safety intentionally. Instead, they redefine acceptable risk gradually until warning signals lose urgency. By the time leadership recognizes escalation, adaptation has already normalized compromise across multiple organizational layers. Leadership believed control remained intact. Certification processes continued. Regulatory cooperation persisted. Internal dashboards indicated progress. From the executive perspective, complexity was being successfully managed through modern systems engineering and software integration. This confidence produced what can be called the command illusion, the belief that oversight mechanisms guarantee understanding. Executives interpreted successful milestones as confirmation that risks were contained. Yet information reaching decision-makers had already passed through incentive filters shaped by schedule pressure and competitive urgency. Critical technical concerns became fragmented across departments, preventing systemic visibility. Each adjustment appeared locally rational. No single decision appeared catastrophic in isolation. Institutional collapse rarely begins with ignorance. It begins when leadership believes visibility equals comprehension. Boeing's command structure increasingly managed reports rather than underlying uncertainty, mistaking procedural progress for genuine safety assurance. As development accelerated, complexity accumulated quietly. Software solutions introduced to compensate for aerodynamic changes expanded in scope and authority. Systems designed as safeguards gradually assumed greater operational responsibility without proportional transparency to pilots or external stakeholders. Every escalation appeared efficient in isolation. Software avoided expensive structural redesign. Training requirements remained minimal. Certification timelines stayed intact. Financial exposure remained controlled. The strategy appeared successful precisely because consequences had not yet emerged. This stage defines silent escalation, failure compounding invisibly while performance indicators remain positive. Organizations interpret the absence of immediate crisis as validation of decision quality. Markets rewarded Boeing's execution. Orders continued. Confidence strengthened. But escalation had crossed a threshold. Risk was no longer localized within engineering challenges. It had migrated into organizational structure itself, where detection becomes exponentially harder. Collapse, from this point forward, no longer required a new mistake, only normal operation under distorted incentives. Institutional failures remain theoretical until systems encounter reality without protective assumptions. For Boeing, that moment arrived not inside boardrooms or certification reviews, but during routine airline operations where design decisions meet unpredictable human and environmental variables. The aircraft entered service appearing operationally successful. Deliveries continued. Airlines integrated fleets without major disruption. From leadership's perspective, execution had been validated. Competitive pressure from Airbus appeared contained. The strategic gamble seemed justified. But operational environments expose interactions impossible to fully simulate. Automated systems introduced to stabilize flight behavior now operated under conditions pilots did not fully anticipate. Information asymmetry emerged between aircraft logic and human response. The critical shift occurred here. Risk moved from engineering complexity into human-system interaction. What had been treated internally as manageable technical compensation became, in live operation, a dependency invisible to those expected to control the aircraft. Exposure had begun, not through dramatic malfunction, but through ordinary use confronting hidden institutional assumptions. When the first catastrophic failure occurred, organizations instinctively interpret events as isolated anomalies. Boeing's initial response followed this pattern. Investigations focused narrowly on operational variables, maintenance conditions, and pilot response sequences rather than structural decision pathways. This reaction reflects a recurring institutional defense mechanism. Accepting systemic responsibility threatens legitimacy, while treating failure as localized preserves organizational stability. Early warning signals therefore struggled to penetrate executive certainty. Yet evidence accumulated rapidly. Similar behavioral patterns emerged across incidents, suggesting shared underlying mechanisms rather than coincidence. External scrutiny intensified as regulators, airlines, and global aviation authorities began reassessing certification assumptions previously trusted without question. The command illusion fractured. Systems believed to enhance safety revealed unexpected authority over aircraft behavior. Leadership confronted an uncomfortable realization. Optimization decisions designed to preserve competitiveness had introduced risks no longer controllable through procedural oversight alone. Once confidence erodes in safety-critical industries, response escalates beyond corporate control. Aviation operates on collective trust. When that trust weakens, regulators act defensively to preserve systemic legitimacy. Global grounding decisions spread rapidly across jurisdictions, transforming a technical crisis into an institutional one. Airlines halted operations. Delivery pipelines froze. Financial exposure multiplied daily. What had been optimized for shareholder stability now produced cascading economic vulnerability. Markets reacted with speed unavailable during internal decision-making. Investor confidence reversed. Legal liabilities expanded. Political scrutiny intensified. Boeing's negotiating position weakened simultaneously across engineering, regulatory, and financial arenas. This phase demonstrates counterforce dynamics. Competitive pressure originally justified accelerated decisions, yet once exposure occurred, the same interconnected system amplified consequences. Institutional momentum reversed direction, converting efficiency gains into systemic fragility almost overnight. At this stage, collapse ceased being reputational and became structural. Production slowdowns disrupted supplier ecosystems worldwide. Certification authority shifted away from delegated trust toward direct regulatory intervention. Internal communications revealed growing misalignment between technical awareness and executive messaging. The organization now faced compounded failure layers: operational grounding, financial loss, leadership credibility erosion, and cultural fragmentation. None originated from a single era. Each traced back through the same decision pathway, prioritizing financial continuity within a domain intolerant of probabilistic risk. What appeared externally as sudden catastrophe was internally the final stage of accumulated escalation. The outcome followed predictable institutional mathematics. When incentive systems suppress early correction, correction eventually arrives through external force. Boeing did not collapse because one system failed. It collapsed because the organization unknowingly redesigned itself to detect danger only after consequences became irreversible. The visible collapse invited a familiar conclusion: technical malfunction caused institutional failure. But this interpretation misunderstands the mechanism entirely. Boeing's crisis was not fundamentally an engineering breakdown. It was a governance transformation disguised as modernization. For decades, engineering authority functioned as the company's risk firewall. Financial performance existed within boundaries defined by physical reality. The restructuring reversed that hierarchy. Financial logic began defining acceptable engineering outcomes. This inversion produced the true failure. Decision-makers optimized for measurable short-term stability while unknowingly increasing unmeasurable systemic exposure. Safety did not disappear. It was gradually negotiated. Each compromise appeared rational within local incentives, yet collectively removed the institutional resistance necessary to prevent escalation. We have observed this pattern before, when organizations mistake efficiency improvements for capability improvements. The institution continues operating normally while its defensive architecture quietly dissolves beneath performance metrics. This indictment extends beyond aerospace. The same structural migration has appeared across industries where financial optimization overtakes domain expertise. When performance measurement becomes detached from operational reality, leadership begins managing representations of success rather than underlying resilience. A similar command illusion emerged inside General Electric during its financialization era, where managerial efficiency overshadowed industrial depth. Comparable incentive blindness later constrained innovation within Intel as process leadership yielded to short-term execution pressures. The recurring pattern can now be named institutional incentive capture. Success attracts financial discipline. Financial discipline reshapes authority. Authority migration weakens technical dissent. Risk accumulates silently until external reality restores balance through crisis. Collapse, therefore, is not industry-specific. It migrates wherever incentives redefine truth faster than institutions can adapt. The most dangerous aspect of Boeing's failure is not historical accountability but contemporary replication. Modern corporations increasingly operate under identical pressures: accelerated innovation cycles, shareholder expectations, and competitive urgency demanding visible efficiency. Artificial intelligence firms, automotive manufacturers, and infrastructure platforms now confront similar trade-offs between rapid deployment and systemic reliability. Leadership teams face incentives rewarding speed while consequences remain delayed and probabilistic. This creates environments where warning signals appear economically irrational to prioritize. Engineers request caution. Markets reward acceleration. Executives interpret momentum as validation. Silent escalation resumes under new technological contexts. The battlefield changes. The logic remains constant. Institutions rarely recognize migration while success persists because the early stages of failure closely resemble operational excellence. Boeing's collapse was never sudden. The outcome became inevitable the moment incentive systems redefined authority inside a safety-critical institution. Aircraft failure merely revealed a transformation completed years earlier, when leadership believed financial optimization could coexist indefinitely with uncompromising engineering risk. The lesson is uncomfortable precisely because it is transferable. Collapse does not begin with error. It begins when organizations lose the ability to hear internal resistance without interpreting it as inefficiency. This indictment closes, but the pattern does not. Institutional incentive capture is already emerging elsewhere, inside industries redefining speed as progress and efficiency as intelligence. Next, we examine another command structure where technological dominance concealed strategic vulnerability, and where early warnings again appeared long before decline became visible. Because corporate collapse is never random. It migrates.